Investing wisely is key to building long-term wealth, but it's not just about making the right moves. It's also about avoiding common mistakes that can derail your financial future. Long-term investing is a marathon, not a sprint, and the key to success lies in consistency, discipline, and avoiding costly errors. In this video, we'll explore 8 long-term investing mistakes that could significantly impact your portfolio and how to avoid them. By understanding these pitfalls and taking proactive steps, you can ensure your financial success over time and grow your wealth steadily. Let's dive in and secure your path to financial freedom. 1. Failing to diversify your portfolio. One of the most fundamental mistakes many new investors make is failing to diversify their portfolio. Diversification is the practice of spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities, to reduce risk. The goal is simple: avoid putting all your eggs in one basket. Without diversification, a downturn in one sector or investment could significantly impact your entire portfolio. For example, if you invested all your money in tech stocks during the 2000 dot-com bubble, your portfolio likely took a heavy hit when the bubble burst. By diversifying, you help protect your investments from market volatility, as losses in one area can be offset by gains in another. A diversified portfolio could include a mix of large-cap stocks, small-cap stocks, international stocks, bonds, real estate, and perhaps alternative assets like gold, silver, or commodities. Spreading your money across different sectors ensures that your financial future isn't dependent on the performance of just one investment. By holding assets that perform differently in various market conditions, you increase the chances of achieving consistent returns, making diversification a crucial component of any successful long-term investment strategy. 2. Letting emotions drive your investment decisions. Investing with emotion is one of the biggest mistakes you can make when building long-term wealth. Emotional investing often leads to impulsive decisions, such as buying high when the market is booming or selling low during market dips, both of which are counterproductive to long-term success. Markets will experience ups and downs, but making decisions based on fear or greed can lock in losses or prevent you from fully benefiting from a market recovery. Successful investors maintain a level head, focusing on their long-term strategy rather than short-term market movements. During periods of market volatility, it's essential to stick to your investment plan, even when things seem uncertain. History has shown that those who weathered the storms of previous market crashes often saw significant returns over the long term. By focusing on the bigger picture, you can avoid knee-jerk reactions and stay on track to meet your long-term financial goals. 3. Neglecting to rebalance your portfolio. Another common mistake is neglecting to regularly rebalance your portfolio. Over time, some investments in your portfolio will grow faster than others, potentially causing your asset allocation to drift from your original plan. For example, if stocks outperform bonds in the market, your portfolio could become more heavily weighted in stocks, which may increase risk. Rebalancing ensures that your portfolio maintains its intended mix of assets. It involves periodically adjusting your holdings to maintain the right allocation between stocks, bonds, and other asset classes. For instance, if you've decided to maintain a 60% stock and 40% bond allocation, rebalancing ensures that you stay within those proportions over time. Rebalancing doesn't require drastic changes, but should be done regularly, at least annually, or when market conditions cause significant shifts. This disciplined approach helps keep your portfolio aligned with your long-term goals and risk tolerance, protecting you from the temptation to chase market trends or overexpose yourself to one asset class. 4. Trying to time the market. Trying to time the market is a mistake that many investors make, especially when they're new to investing. The idea of buying low and selling high sounds appealing, but predicting short-term market movements with accuracy is incredibly difficult, even for the most seasoned investors. Market timing can lead to missed opportunities. When investors attempt to time the market, they may sell during a downturn or fail to buy when the market is low, ultimately harming their long-term returns. Historical data has shown that even if you miss the best performing days in the market, it can severely impact your portfolio's growth. Instead of trying to time the market, Focus on buying good assets and holding them for the long term. By consistently investing in quality companies or funds and staying invested, you can take advantage of long-term growth without being distracted by short-term market fluctuations. 5. Ignoring the power of compound interest. Compound interest is often referred to as one of the most powerful forces in investing. It's the process where you earn interest not just on your initial investment, but also on the interest that has already been added. Over time, compound interest can significantly boost the growth of your investments, especially when you start early. One of the biggest mistakes is waiting too long to begin investing. Even small amounts invested early can grow into substantial sums over time due to the power of compounding. If you start investing in your 20s and keep contributing regularly, the compounding effect can lead to exponential growth by the time you reach retirement. For example, investing $5,000 at an 8% annual return will generate $40,000 after 40 years due to compounding, even if you don't add any more money. The earlier you start, the more time your money has to grow and compound, making a huge difference over the long term. 6. Focusing only on short-term gains. Many new investors focus on short-term gains, chasing high returns over a few months or years. However, this mindset can derail long-term success. Short-term investments often come with higher risk and can lead to emotional decision-making, which, as mentioned earlier, is detrimental. Investing with a long-term perspective allows you to take advantage of market cycles and compounding. While you may experience periods of volatility, staying invested over the long term allows you to benefit from steady growth, particularly in well-established companies or broad market index funds. The key is to remain patient and avoid getting swayed by the market's daily fluctuations. Long-term investing is about being committed to your financial goals and sticking with a strategy that has proven to work over time. 7. Overlooking fees and expenses. Many investors overlook the impact of fees and expenses on their long-term returns. Whether it's management fees for mutual funds, commission fees for trades, or hidden costs in certain investments, these fees can add up over time, eating into your potential gains. For example, an investment that charges a 1% annual fee might not seem significant, but over 30 years, it can reduce your portfolio's value by hundreds of thousands of dollars. Low-cost options, such as exchange-traded funds, ETFs, or index funds, generally have lower fees and can be more efficient for long-term growth. Before making any investment, always check for hidden fees and compare the costs. Opt for investment products with low fees, and consider using tax-advantaged accounts like IRAs or 401(k)s to minimize taxes on your investments. Paying attention to costs helps maximize your long-term returns, allowing your wealth to grow more efficiently. 8. Not having a clear investment strategy. Lastly, one of the most detrimental mistakes is not having a clear investment strategy. Investing without a plan is like driving without a map. You might end up somewhere, but it's unlikely to be where you want to go. Having a well-defined strategy gives you direction and helps you stay focused on your long-term goals. Your strategy should include your risk tolerance, investment horizon, asset allocation, and financial goals. Whether you're aiming for retirement savings, buying a home, or funding your children's education, having a clear plan ensures that your investments align with your objectives. It also helps you stay disciplined and avoid the temptation to chase short-term trends. Regularly reviewing and adjusting your strategy as needed is equally important. Life changes, and so do market conditions. By having a flexible yet solid plan, you can adjust your approach to remain on track toward your goals, no matter what comes your way. There you have it, 8 long-term investing mistakes you should avoid at all costs. By being mindful of these common pitfalls, you'll be better prepared to build wealth, reduce risk, and achieve your financial goals. Remember, investing is a long-term commitment, and avoiding these mistakes will ensure that your wealth grows steadily over time. If you found this video helpful, make sure to give it a thumbs up, share it with your friends, and don't forget to subscribe for more valuable financial insights. Let us know in the comments which investing mistake you're most focused on avoiding, and how you plan to improve your investment strategy. I'll see you in the next video.